Okay, everyone, we're getting ready to start. Am I loud enough? Can everybody hear me?
Yeah. I can turn it up a little bit. Can we turn it up a little bit?
Yeah, maybe.
Okay. Right now.
All right. Everybody had a chance to get their food and drinks. I think there's even more food coming, so just in case. And feel free, please do not feel uncomfortable getting up and getting food and drink during the presentation. We want everybody to be comfortable here today. So with that being said, for those of you who don't know me, if there's anyone in this room that doesn't know me, my name is Kristina Kuprina. I'm the CEO and founder of Sequoia Wealth Advisors. And many of you have heard my webinars. I do them once a month, where we have myself talking about the economy, or we have a special guest speaker. And once or twice a year, we also like to do something live and in person. And I really want to take a moment here to shout out the people that made this possible, because it definitely wasn't me. Okay, I'm just doing the budget side of things. So if it wasn't for Andrew Devlin here from Pitch Hub, right? He's making it possible. He is handling all of the technical aspects that I don't fully understand. And we got hundreds of people on the Zoom that's being live streamed right now too. So he's making all that magic happen. Also, I want to put a shout out to Caitlin King, marketing and client relationship specialist, and she also is involved with putting this entire event together and getting our speakers and all of that together. Mia, who cannot be here this evening, also made it possible. Tremendous undertaking to organize everybody who wanted to be here live and making it happen. So I just want to shout out to her as well. Just an amazing team of 23 people at Sequoia that makes all the magic happen every day. That being said, just a couple of super quick housekeeping things. So many of you have heard our speakers. So tonight we're going to have our special guest speaker, senior economist at First Trust, Strider. You guys have heard him speak before. A couple years ago, he's been out talking about a lot of great subjects. He's really well received. So he's going to be here live and speaking. After that, Roth is going to do a really quick talk too, a little bit about markets and perspective, short presentation that again, all of this is really relevant. Obviously, we have changed this presentation so many times up through this morning, and it may not be relevant by the time we finish this evening. So I say, please give us grace that this is effective April 25th, 2025. And things are moving pretty rapidly right now. You all know that you can always ask questions anytime, reach out anytime, again, as things change. After they speak, there'll be a Q&A after each one of them speaks. So any questions you have, ask them directly. If time permits, because I promise I'm not going to keep you here crazy late tonight, I'll do a little talk. I'll fill in some gaps, things that may have not talked about, answer some questions you guys gave to me in advance. And from that, and Katie will say a couple of words, and we will be done. So again, try to be respectful of your time in both ways. Number one, you guys took valuable time out of your life to come here this evening and spend it with us. So we want to make sure we're respectful of your time. At the same time, we also want to make sure you get everything you want out of this evening. So please ask the questions. Please share what it is that you want to know. Get the best and highest out of all of this. This is more than just the economy. The economy and the economic updates is our excuse to bring us together, for us to connect to one another. There's a lot to be said for the social engagement that is so important and so valuable, especially because we went through a period of time when it wasn't so easy to do it. So that connection that I have with each of you and seeing you in person and hugging you and touching you, it may sound kind of corny, but that's really special. That's really special. As wonderful as Zoom has been to make our lives more productive, nothing will replace that human connection and interaction. So I really, really appreciate all of you, not only those of you that are here live, but also those of you who are listening and those of you who are listening to the recordings later. Thank you. Last thing, before I introduce our speaker, one thing, questions, please, please, please. You have a little notepad in front of you, jot down questions. Okay, if you are not comfortable asking them publicly, you don't have to. You can set them aside and we'll get them answered for you later. So whether you want to ask them tonight, ask them not, put down notes you have for yourself, any questions you might even have for Katie or I later about your financial plan or your specific portfolio. Everything we do is custom. Nothing you hear today is going to be what you are doing. Each of you is doing something different. And so questions about that you wish to ask confidentially, please don't hesitate. Reach out to Katie and I afterwards. So that being said, Strider, are you ready? So Strider is going to come up and talk about the economy. Maybe y'all want to get another drink before you start. All right. Oops. I just carry it like this. All right, wonderful to be with you all. Obviously, a lot going on in the economy. I'm going to try and cover as much as we can in the short time that we have. We won't keep you here forever, and I know there's a lot going on, but I want to start off with a quick story. I was doing an event like this a couple of weeks ago now, and right before I was about to get up to speak, my wife calls me. And I quickly picked it up and said, hey, is everything okay? I'm just about to speak. I could tell by her voice something was wrong. I said, well, what's going on? And she said, well, I was backing out the car and I hit the side of the garage. I said, oh, well, are you okay? Yeah, I'm fine, but there's a little bit of damage to your car. I said, well, how much are we talking about here? And she said, well, it's not bad. There's a little piece of the side mirror that came off, and then there's a little scratch in the front. I said, well, it's fine. Let me send me some pictures. I'll deal with it later. But I got to get back in. I got to do that. So I got done presenting, and was heading out. And I was looking at my phone, and I saw these messages from my wife. So I started to go through them, and here's a little piece of the mirror. It's frozen here. Sorry, it's frozen. There we go. Here's a little piece of the mirror. Let's see, here's a little scratch on the front. For some reason, this isn't working. There's a little scratch. Perception is not always reality, right? The reality when we took it was a lot different than her perception. I'll tell you that much. But the same I think is true about the economy as well. Things aren't always the way they may appear, and I think especially going into this year, the perception was that it was going to be another very strong year of not only economic growth, but for the markets. You look at analysts, for instance. Here's all the analysts on Wall Street. Average the highest was at 20.7% for the year. And again, it's early in the year. Maybe we do hit these targets, but the average gain for the year was about 11.1%. We were actually, this is us right here. We were actually the only ones that were negative for the year. And so far it's been accurate, unfortunately, but it has. But the reason that we were negative was because I think the reality was a lot different than what the perception was. And the reality is that the economy was coming off of basically 4 years of massive stimulus and deficit spending, and finally was now coming to an end. And so we did see big inflation, that was part of it, but we just thought there had to be some other payback. On top of that, the economy to us, although the headlines still looked okay, underneath things did not look that great. And I'll go into some of that we're seeing currently. But you think about really what we've been through over the last 4 years, it really goes back to that period of time, I'd say of March and April, when we shut down the US economy. I mean, we never seen that before in history. 95% of people were on stay-at-home order. 95%. And that caused the steepest, sharpest recession that we've ever seen. You look at employment, for example, we were adding jobs. This is the longest recovery we've ever seen in history. About 200,000 jobs per month, all the way through February of 2020. Am I out of the picture? I'm sorry.
No, you're good. No, you're good. Don't worry about me.
Until February of 2020. And then as March rolled around, as the shutdown started to take hold, we lost in that single month 1.4 million jobs. And we never seen anything like that before. Almost double any of the largest declines we saw during the Great Recession. But that was nothing compared to what we experienced in April when the shutdowns really took hold. This is the exact same chart, but with April on there. And between March and April, we lost 21 million jobs in the United States. I mean, that's almost equivalent to all the jobs that we gained in the longest recovery that we'd ever been in history. I mean, look at that. 21 million gone in 2 months. Looks like nothing compared to what we experienced in the Great Recession. Good news is we finally added back more jobs than we've lost, but job growth has been slow.
we're still adding about 150,000 jobs per month on average, going back over the last year, which is, not booming, but it's not terrible. It's enough to keep unemployment about where it is. But what's concerning to us is the type of jobs that are being created. I really want to focus on just three areas here. I want to focus on government jobs that have been created, leisure and hospitality, because it's still recovering from the shutdowns that occurred, and then lastly, education and health services, which is really driven by government spending as well. When you take a look at those three areas versus everything else, from 2015 to 2019, everything else made up about 52% of jobs. Just those three categories made up about 48%. Then we had the pandemic, the shutdowns that took hold, that really steep recession. We started to come out of that recession in May of 2020. That's that next section, May through December of 2022. Again, you look about 54%, everything else, 46%, these three categories. And you look at government just at 2% here. But I want to focus on what's happened over the last 2 years. Because when you look over the last 2 years, look at that. Only 13% of jobs from everything else have been created. 87% of job growth over the last 2 years has come from these three areas. Mainly, really, those two that are government driven. And we just don't believe that's going to continue. And so that's a concern for us moving forward here. We think we will see slower growth in jobs and a slowdown in the economy as well. But all in all, when you still look at the consumer, I'd say things still look to be okay. Yes, household debt sitting at record all-time highs. Never been higher, but if you look at this every single year, really take out the recessions, in almost every year, it's sitting at record highs. I can take this back 100 years. A lot of trouble. They didn't just have one home. A lot of people had 2, 3, 4, 5. Everybody just thought housing prices would never come down. They put very little money down on these homes, so all of a sudden when they could no longer afford them, they just let them go. We had massive inventory builds, and demand fell off a cliff with higher interest rates, and we had the housing collapse. Well, you look at national home prices today, they're still sitting at record highs. We expect them to continue to grow. And people kind of scratch their head, how is this possible? How are we not in a bigger bubble than we were back then? But the big difference today is when you look at the 70% of mortgages, I look at this as a huge benefit. Because about 95.2% of those mortgages outstanding are fixed rate mortgages. Only 4.8% are adjustable rate mortgages. But where it gets really interesting is looking, well, what are they actually fixed at? And we got about 20% of mortgages that are fixed at 3% or less. Another 30% are fixed between 3 and 4%. Another 15% between 4 and 5%. So you've got a little over 75% of mortgages that are fixed at 5% or less. Meaning, especially in these two categories here, a lot of people are in there, over 50%. It's very hard to convince somebody in those categories to be willing to sell their home to buy an equivalent priced home, where all of a sudden they might have to pay double or triple that mortgage payment they were paying before. Just doesn't make sense. So although demand's come down substantially for housing because interest rates have gone up, at the same time, supply has come down substantially too. I think since we're in the Santa Cruz area here, I take a look around what's available for sale right now. Inventories are low. We all know that, right? If you're looking, maybe you have a son or daughter that's been looking for a home, and there's just nothing out there. Found this is up in San Jose. This is for sale for about 1.6 million here. This great this steel, they call it. We got 2,700 square feet here. They actually increased the price by 125,000. But the real kicker is in the overview of this great opportunity. It has an inactive meth lab. So for about 1.6 million. That's what you guys can get right now. Not much on the market, right? Wow. I did call up the realtor. She says for $10,000 more, they'll reactivate that meth lab. The sidelines there. But not only have we seen prices go up for housing, prices are up about 50% nationwide over the last 5 years, but we've really seen prices go up across the board for everything. Inflation's been a huge issue. And I think it's important to realize, well, why have we seen this inflation? Because a lot of people have come out and said Elon Musk has been a big proponent of it, especially, he's come out and said, what drives inflation is massive government spending. And the reality is that's not really true. And so I wanna show you why that's not always the case. And it's pretty easy to see, it's blue line here, it doesn't matter if you're a Democrat or Republican, this is government spending. It just always seems to go higher and higher. Think back to this period here. Remember when we had the financial crisis and all those government programs, TARP and other stimulus programs, and at that time they're like 750 billion, and everybody, 750 billion, I mean, it was massive money. We never seen anything like that. And how will we get through that? And the line doesn't look that big anymore, but at the time, I mean, that was massive. Again, we did not see any inflation after that massive spending. Well, we keep going, and then you look at this. I mean, we added trillions of dollars of new spending to the economy. This time we did see inflation. So does correlation necessarily mean causation? No. So what happened? Why were these two periods different? Well, when you think about the way government spends money, government either borrows it or they tax it. Now, usually they do that from the private sector. So think about a pool. Inside that pool, you have all this money. That's the economy's money. And usually what the government does is they take their bucket, they go and dip it into the deep end, and then they carry it over to the shallow end and they redistribute it into the shallow end. The actual level of water hasn't changed, but where that water was has moved. But the water level's the same. That's what happened back in 2007 and 2008. The government borrowed from the private sector. It was money that was actually outstanding already in the economy. That's why it wasn't inflationary. But what happened in 2021 right here is that instead of borrowing it from the private sector, the government decided to borrow that money from the Federal Reserve. So the Federal Reserve created trillions of dollars of cash out of thin air. And they purchased from the Treasury Department trillions of dollars worth of bonds. So now all of a sudden the Federal Reserve has all these bonds and the Treasury Department has all this cash that was created out of thin air. Now the Treasury Department took that cash and distributed it, put it into people's banks accounts with stimulus payments. So all of a sudden we saw trillions of brand new money enter the money supply in the United States. So think back to that analogy of the pool. Essentially what happened was the Federal Reserve backed up a water truck to the pool. They turned on the spigot and they just let it run. And the pool overflowed. We had way more money than there was needed in the economy. Here's a picture for you of that measure of money supply. So this is all money outstanding in the US economy. It's called M2 money supply. You can see from 1995 to about 2020, it was growing right around 6% a year. Then all of a sudden, look at this massive increase. We added to the economy, to the money supply, 40% more money in a 2-year period. Never before have we seen that. Not even in the 1970s did money supply grow at that faster rate over such a short period of time. The second this started to tick up was when we started to get very concerned about inflation, because as Milton Friedman always taught, inflation is just too much money chasing too few goods and services. If you grow money supply by 40%, but you don't grow goods and services production by about 40%, you're going to have more money for good or service. And that's what we have seen. And so moving forward here, where's inflation headed? Well, I think inflation is going to continue to come down. Now, is it because the president and the rest of the rest of his party are looking to cut spending? Is that what's driving inflation down? No. The real reason is you see money supply actually peaked and then it was declining. It's growing again, but it's still growing at about 4%, slower than what we'd seen. Eventually, this will get back online with where things were. So we expect inflation to probably continue to come down. Now, we'll talk a little bit about tariffs, but that'd be a one-time hit to prices, so it wouldn't necessarily be inflation, which is price increases over a period of time. But the president does want to see spending cuts, and a lot of people are worried, are we going to see millions of jobs lost from the government side? What's going to happen here? How much can they actually cut? And we've had a couple case studies of this going back, looking at Clinton tried it, but I think the most likely one, or the most similar one so far, is what happened under President Reagan. And in 1982, President Reagan wanted to figure out ways to cut government spending. And so he went out and found a business leader. At that time, it was Peter Grace. This is a picture of Peter Grace. He was CEO of W.R. Grace, and he put together the Grace Commission, which had about 160 business executives on it. And over an 18-month period, they combed through government spending, figuring out ways to cut. And over that 18 months, at the end of it, they came up with about 2,500 different ways to cut government spending. And if they did these, they said, if you guys implement these, we could actually reduce the deficit over 3 years by about $425 billion. What does that mean? Well, it means by the year 2000, that debt outstanding for our economy will be about $2.5 trillion. If we don't do any of these, it's going to be more around $11 to $12 trillion. So they put together this really nice book, the Grace Commission Report. I've got a copy of it. It's like this. It's actually fairly thick. I mean, it's an interesting read. Congress looked at it. They said, wow, this is amazing. Good work, guys. And they did nothing. No cuts, nothing. And here we sit today. Government spending we got deficits of about $2 trillion now. And we have debt that's $36 trillion. And so it's a bigger uphill battle today than it was even back then. But the reality is, yes, we're hearing so much about things that Elon Musk and the Department of Government Efficiency are finding, fraud and other type things. But the reality is it going to be enough to really move the needle in terms of cutting government spending? Because when you take a look at government spending, we're projected this year to spend about $7 trillion. But you start to go through, well, what could we cut right away? Well, Social Security, mandatory, Medicare, mandatory, Medicaid, mandatory, other mandatory, I assume is mandatory. Defense spending, mandatory, net interest, mandatory. So that really leaves this non-defense discretionary section here, which is about 13% of government spending. Even if tomorrow we cut that to zero, obviously it's not going to happen, but let's just say tomorrow they wipe that whole section out. Within 4 years, those other programs grow automatically, and it would surpass all of that just in 4 years. So even freezing government spending at the current bloated levels of $7 trillion is going to be a task in itself. Is it possible? Yeah, it's possible. Is it probable? No. But what I'm excited about is that we have somebody like Elon Musk at the helm that's looking into all these things that hopefully, if nothing else comes from this, what is going to come from it is way more transparency in the way that government spends money. And that in itself, I think, will be a big win. But when you take a look at government revenues, I mean, we're bringing in right now $5 trillion. Now, that leaves us with a $2 trillion deficit. That's just unsustainable. Something has to be done. And so it'll be interesting to see what happens. But in terms of seeing massive spending cuts, no. If anything, they'll be very gradual. But the reality is what's the issue here? A lot of people say, well, why don't we just tax the rich more? But the reality is, if you go back over history and take a look, this goes back to 1950. I like to use post-World War II data because it's a little bit cleaner. The average for revenues coming in as a share of the economy is right around 17.5%. Sometimes it's been a little more, sometimes it's been a little less, but you need to think about marginal rates have been all over the place, up in the 90% for the highest, 30%, I mean, all over the place. Now, it might look a little bit more bouncy, but this is from 10% to 35%. If I took this from 0 to 100, it looks like almost a straight line, right around 17.5%. But you take a look at government spending, that's that blue line. On average, it's been right around 20% of GDP. Why do we always have a deficit? Because we're spending more than we're bringing in. So if we ever want to see a balanced budget, we need to figure out a way to get revenues around 17.5% and government spending down to around that. Now, Clinton was able to actually do that. He actually got spending down to about 17.5%, and that caused revenues, I'd say, to spike. We had a surplus. But you look at where we are today, revenues are actually at their historical average, right around 17.5% of GDP. Spending, on the other hand, is sitting at 23% of GDP, well above the historical average. And really, it's been sitting well above the historical average for quite a long period of time. And so the issue really is on the spending side. What this shows you, it's a pretty simple model, but if nominal GDP continues to grow around 4.5%, so that's about 2% inflation and 2.5% real growth, that's not really out of the question whatsoever over the next 5 years, let's just say. We would actually be able to see a balanced budget if we were able to just freeze government spending. This would drop all the way down to here, while at the same time, revenues continue to come in at that 17.5%. So it sounds really easy, but even just freezing government spending at $7 trillion today, with all the growth of those mandatory programs, is where the big issue is. Now, the other big fear is what's going on with tariffs. And, first off, I do not believe tariffs are a good negotiation tactic. If you asked me back in 2018, when this was the last time around, I would have told you the exact same thing. But last time, I'd say it worked to some degree. Even though it caused a lot of turmoil, what we actually saw at the end of the day is that majority of countries, actually every country that we signed a trade agreement with, actually lowered their tariffs. Now, this is the way I believe you can sum up in one chart the way that Trump looks at the world. Now, I disagree with this. I think you need to look at it from a consumer perspective, but he likes to look at it from the producer perspective. And what he says is, for so long, our producers have struggled to export to your markets because you charge higher tariffs than we do. And at the same time, we allow your products in for cheaper. And so you guys have been able to benefit while we haven't. That to him is not fair. And here's a chart. These are our 10 biggest trading partners. You see every single one of them charges a higher tariff. And so I think Trump's logic is, look, either you lower your tariffs to get more in line with us, or we're going to raise our tariffs to get more in line with you. And this is as of 2023. But if you go back to 2016 and you take a look at all the countries that he made trade agreements with, Japan lowered tariffs, Canada lowered, EU lowered, we didn't do Taiwan, Mexico lowered, China lowered, Brazil lowered. I mean, the ones really that we didn't do any trade agreements with saw tariffs go higher. So is that going to happen the same this time around? No, I don't believe so. I mean, hopefully it does, but I think there's a lot of other things going on than just trying to see lower tariffs. Number one, I really believe that President Trump wants to raise a lot of new revenue from tariffs. And even if he puts on a 10% flat tariff across the world, that's going to bring in a couple $100 billion extra in revenue. And he wants to use that for maybe getting rid of income tax for those making 150 or less, 1,000 or less. I mean, he's got a lot of different ideas. And I think it's great to have ideas, but I think the tariff part of it is going to be damaging, because the reality is that majority of that tariff is going to be borne by consumers in the United States. But I think the bigger issue that we're facing here is that he wants to see trade deficits go away. He thinks that the United States is losing if we have a trade deficit. But you have to think of what's a trade deficit made up of. It's just made up of a bunch of individuals that have trade deficits. And that makes the big trade deficit. But the reality is that we have trade deficits. There's nothing wrong with having trade deficits. I mean, I love Chick-fil-A. I've got a massive trade deficit with Chick-fil-A. I buy their chicken, I consume it, and I give them dollars. But what does Chick-fil-A have a massive trade surplus with me? They have a massive capital surplus. I give them my dollars. So that's the opposite of a trade deficit, is a capital surplus. Now you have to think, everything that we're buying from China, from everywhere else, we're giving them dollars. Well, those dollars are really only good in the United States. So what do they do with those dollars? Well, they buy our treasuries, or they invest in real estate, or they invest in our stock market. They have to bring those dollars back into the United States. And I think the bigger issue is that we're the world's reserve currency. And as such, people want our dollars. They need our dollars. And so by necessity, we have to run a trade deficit so that countries can run capital surpluses to have our dollars. So it's almost impossible. It is possible, but it's almost impossible if you're the world's reserve currency to run a trade surplus with the world. It just is not, it doesn't work. There is a way, but it just doesn't work. So how do we get to a place where we have no trade deficits? Well, you really have to create a country that people no longer want to invest in and drive it into the ground. And that would lower the trade deficits. Now, do I think we're on that track today? No. But if we continue to go down this path for, 20, 30 years, we could definitely get there. And so is it concerning where things are today? Yes. But I believe the reason that the market is lower today, yes, tariffs are what really kicked it off. But the reality is that coming into this year, the stock market was overvalued by almost any measure that you look at, which is why we thought we'd see a decline, because the economy, we just believed, wasn't going to hold on. But does that mean that I'd run for the hills and move to cash? No, not at all. There's so many great ways to get yield in this environment. And just being diversified, you've probably done a lot better this year than the market overall. Everybody's situation, as Kristina said, is different in this room. And I think that's why it's more important than ever to have a financial advisor today, to walk you through situations like we're dealing with today, because it is complex. I mean, there are thousands of different funds that you can put your money into. That's her job to have to sift through those to figure out which ones are the best ones, and our job to help her do that as well. But I would not be moving to cash. I mean, you think about the next 5 to 10 years, I think some of the best returns that we have seen are just right around the corner. Yes, in the short term, I'd be more cautious here. But when I look out over the next 5 to 10 years, I mean, you think about all the new technology that's come online over the last 20 years, the cloud, smartphones, tablets, 3D printing, hydraulic fracturing, horizontal drilling, which has revolutionized the energy industry, nanotechnology, biotechnology, artificial intelligence. I mean, the list goes on and on. These are the things that are really driving growth despite all the headwinds that we've been facing. And for me, you think about that smartphone, it's the most amazing technology that's ever been created because it allows us to consume information like never before in history. Masai warriors in the most remote part of Africa, most of them have access to smartphones now. That means the Maasai warrior has more information available to him than the President of the United States did just 20 years ago. And yet the average Apple user swipes open their phone 80 times a day. So let's just say 40 of those times they're looking at media. You're not hearing about the 99 homes that didn't burn down. You're hearing about that one home that did. And you hear about it over and over and over again. And so I think it gives us a little bit of a perverse view of this world. It makes it feel like things today are worse than they've ever been in history. And yet, when you look at living standards in the United States, they just continue to grow. Not all the time, but over time. And I think that's what's so important for us to remember. I mean, this is 175 years of history here. Think of all the terrible things that happened over this period of time. And yet, living standards grew 20-fold over this period. 20-fold. Being optimistic doesn't mean bad things aren't going to happen. We open the newspaper, that's all we read about. But I would argue there's so much more good going on today than there is bad. And almost every year that good section gets a little bit bigger while that negative section gets a little bit smaller. But I think especially with the advent of the smartphone, the amount of information we read about that much smaller negative section has grown almost exponentially, that we miss out on so much of the good that's going on all around us. And so I think today more than ever, perspective really matters. And when you look at the way that our country is built with private property rights, rule of law, and a functioning democracy, those three things in place make this a breeding ground for the entrepreneur. It's not always easy, and I think this is going to be a tougher year. But that entrepreneur is alive and well. When you think about the Magnificent Seven companies that have done so well over the last decade, I think a big reason why they've done so well is they've been heavily investing in artificial intelligence for the last 10, 20 years. And I think about a company like Netflix. You guys remember back in the early 2000s, Netflix used to send, it used to be DVDs. You remember getting those little red envelopes? You'd have a little grading system on it. You watch the DVD and then you send it back. And then they say, okay, if this person, you like that, this person likes this. They started to build out an algorithm. I mean, they were just all they were was a machine learning company by direct mail service. And it wasn't until 2007 that they were able to have an online streaming platform. Kind of crazy, we weren't streaming stuff before they're on the internet. And they built out this massive platform and everybody started to come and use it. And all of a sudden they started to get real-time information like never before. And they built out the most incredible algorithm. By 2011, I mean, they knew exactly what you'd want to watch. And they said, well, we've been our whole lives, our whole company's life, we've been a distributor of TV shows and movies. I think we should become a producer. I mean, we know exactly what people want. with our models. And so they went out into the marketplace in 2011. And that year, House of Cards was promoting their show. They went to every single big TV producer. Every producer loved it. They thought, this is great. And they said, send us your pilot. And they said, well, we don't have a pilot episode. And they said, well, no pilot episode. I mean, we like it, but we don't know if our audience is going to like it. And in that year, I mean, you look back in 2012, there's 113 pilots that were commissioned. It cost $400 million to make those pilots. Of those 113, only 35 of them made it to air. Of those, only 13 made it to a second season. So only 1 in 9 pilots made it 2 seasons or more. $400 million. Doesn't seem like a great investment. That's how it always had been done. But then Netflix came in and changed the entire game. This is in Kevin Spacey's words. He was a star of the show. He said, we believe in you. We've run our data, and it tells us that our audience would watch this series. We don't need you to do a pilot. How many episodes do you want to do? And Netflix went to House of Cards. And they said, hey, how about we give you $100 million up front for 2 seasons? I mean, everybody was blown away. Can you imagine all those TV studios in their ivory towers thinking, these guys have no idea what they're doing? And sure enough, very first year, 2013 is when this came out. Netflix right down here, very first year ever, number 10 for Emmy nominations. I mean, they didn't have very much that could be nominated. But by 2018, Netflix is either number 1 or number 2 every single year. Why is that? Well, it's because they have an unbelievable AI. They've built out an algorithm that knows exactly what people want. Think about the productivity gains that that company is seeing. Well, those are the productivity gains that are starting to move to small and medium-sized businesses. You think about the productivity that we're going to see over the next 5 to 10 years, it's going to be immense across all industries. It's not an overnight deal, and I think that's why the market's gotten ahead of itself. It's going to take time for companies to figure out how to use AI in the best ways possible to make themselves more and more productive, but it's happening. And so in the short term, yes, I'd be cautious here. I think things got overdone. But over the next 5 to 10 years, I think some of the best returns that we've seen in a long time are just right around the corner. I'll close with this. This is one of my favorite economists. His name's Thomas Sowell. If you've never, he's actually at Stanford here. If you've never read anything of his, I highly recommend anything he's written. He's written over 100 books. He's in his 90s now. I mean, that's impressive. Probably over 2 books a year, some years. I don't know how you do that, but he's incredible. But I love this quote from him. The caveman had the same natural resources at their disposal as we have today. And the difference between their standard of living and ours is the difference between the knowledge that they could bring to bear on those resources and the knowledge used today. I mean, it's so simple when you think about it, right? But it's true. I mean, why do things get better and better? Because we keep growing on the shoulders of those that come before us. But with technology today, it's allowed for us to even move that faster. You think about what's going on with artificial intelligence, with these large language models, how smart they're getting, and how it's growing at an exponential rate over the next couple of years. I mean, they're going to be able to touch every single aspect of the internet. That smartphone every day gets more and more valuable because the network gets bigger and bigger. More and more ideas come onto it every single day. We probably have cures for diseases and cancers already on the internet, but we just haven't been able to put all the pieces together. Well, now we'll have the ability to do that over the next 5 to 10 years. It's incredible to think about where things are going. Is it scary? Sure. But I think if yourself, you look back 15 years and you saw where things were today, you probably wouldn't believe it. I use a smartphone for my entire life. I mean, 15 years ago, it was a foreign concept. I think 15 years from now, if we're back here, we'll all be using AI in a big way for our life, and we won't be able to figure how we lived without it. So again, in the short term, I'd say be a little bit more cautious here. That's why it's great to have a financial advisor. But over the long term, get ready, because I truly believe some of the best returns we've seen in a while, we've had some good returns, are just right around the corner after this reset. Thank you all so much. It's been a real pleasure to be with you. Well, Ralph, you can come up if you want, but if there's any questions, I'm happy to take any before Ralph kind of closes things out here. Yes?
Where's the best opportunities to invest in AI?
I think over the longer term, over the next 5 to 10 years, it's going to impact every sector. So
Question.
the question was, where should we invest in AI today? One area I think still undervalued is infrastructure. I think the amount of infrastructure we still need to build in the United States alone is pretty massive. Whether data centers get put off or not, our aging infrastructure is pretty poor today. So something big is going to happen there over the next 5 to 10 years. On top of that, I'd be looking more towards healthcare. I think in healthcare, we're going to see a lot of AI application over the next 5 to 10 years. Healthcare as a sector in general looks undervalued to us today. Financials look fairly undervalued today too, and I think it's going to impact financials in a big way. AI in general, tech, I think it's coming back down to earth, but it still looks a little bit overdone to us today. But if you're holding for the next 5, 10, 15, 20 years, I think all those companies are going to work out really well for you over time. Was there another question over here? No.
To what extent do you use AI in your business?
To what extent do I use AI in my business? I don't use it for modeling and that kind of thing yet. We're starting to move that direction a little bit to take some of the work off of my shoulders and other shoulders to be able to get data in a way, have it streamlined to us in Excel or other programs. We're still pretty much all Excel to do most of our stuff. There's new stuff that's coming out, but just as I said, it takes time to figure out the best way to adopt it. You don't want to take on something that if there's an issue with it, that all of a sudden it can mess up your models or everything. You can't go back. So I think a lot of people are moving slowly. We especially have been moving slowly into using that. But for writing especially, it's been a massive benefit in terms of just having somebody that you can bounce. It's not somebody, it's a model, but having something that you can bounce off ideas to. Like, hey, I'm thinking about this. How am I thinking about this? Is this the correct way to think about it? I've got a lot of role models in the economics profession that have written a lot of books like Thomas Sowell and so forth that I can say, hey, if I was talking with Thomas Sowell today and this is my argument that I was making, would he agree with this or would he disagree with this and why? And it'll give you, goes through instantly everything that he's ever done, all the articles he's ever written, all the books he's ever read, and has a conversation like I'm talking to Thomas Sowell. And stuff like that is pretty amazing to work through some of that type of stuff. So mainly I've been using for myself more large language models for different things. I think Grok, which is X.AI, model is phenomenal to play around with, whether you want to make images, stuff that's off work right now. I'm looking at building a hotel and just to have, get renderings built instantly that, I'd have to pay an architect. Eventually I will have to pay somebody, but just to have an idea of what it could look like, instantly build this beautiful idea just based off of my descriptions. I mean, it's incredible. And so you see savings there already.
So in your business as well as all other businesses, do you see it as a battle of who's going to eventually have a better AI?
Yeah, I think AI will continue to get better and better. And I don't know which one will win out. And I think they'll be used for different things. They'll specialize in different areas. But I don't know if it's going to be who has the better AI, but who can use it the best to complement what they do. So an example of that would be like a doctor. We have a big shortage of doctors in the United States as it is. And I think partly it's if we can have doctors more focused on just doing surgeries instead of having to look at scans and all these other things that they have to do on the side that AI can do. When you think about a doctor that specializes in, say, breast cancer or some type of cancer, and they've been there for, say, 30 years. I mean, they've seen 1 million scans. And so they can look at a scan and they can pretty much tell you, hey, this is worrisome, this isn't. But now we're able to have AI that can look at, 100 million scans or 1 billion scans, where there might be something that a normal doctor, just even with 1 million scans, hasn't seen. But in 1 billion scans, it shows up maybe 20 or 30 times. And they can say, well, this isn't likely, but it looks fine, but I would look at this. And then they can take a deeper look. And you think about the savings that are going to go from there. So I think it's more going to be it'll replace some jobs for sure, but I think it's going to be a huge benefit enhancer to jobs where it's going to make you way more productive and more efficient. Any other questions? Yes.
Could you speak about stagflation?
Sure. So stagflation is basically high inflation and slow growth. It looks like there's a possibility that we could enter into a phase of stagflation moving forward here. Growth looks like it's slowing down, and a lot of people are worried that we might start to see inflation pick up due to tariffs and whatnot. I think if there is a chance, if there's a flat 10% or whatever it is tariff across the board, yes, prices across the board are going to rise, but that's going to be a one-time hit. And then from there, it matters, are we going to continue to grow prices at the same rate that it was, or is that going to come back to growing around 2 or more percent? I think there's a possibility, definite possibility that we head towards stagflation here. And I think the Fed believes there's a possibility that we're going to head towards stagflation too. And so I think the chances of the Federal Reserve bailing out the economy this time around are a lot slimmer than we've seen in the past, because in the past, inflation's been very, very low, where today we're still above their target 2%. We're closer to 3%. And I think that will generally come down. But if for some reason the economy crashes or continues to decelerate like we believe it will, and at the same time prices go up, it becomes kind of a vicious spiral where the Fed can't really do too much. You kind of have to wait it out almost, and it can cause a pretty serious recession before you can really get out of that. That's not our base case. I think we'll probably see a mild recession at some point down the road here. And we'll get through that and we'll see inflation kind of stay tame, but there is a possibility of that. Yes.
There's a lot of talk about the unpredictability of the president causing a lot of chaos in the market. So how do you deal with that unpredictability?
Yeah, I apologize for not bringing that up in my presentation. You know, this reminds me, I've got 4 kids. I've got a 9-year-old, a 6-year-old, a 3-year-old, and a 1-year-old. And yeah, we're busy. Well, my wife's very busy. I'm here, so she's very busy. But my 9-year-old and 6-year-old, they love to play Candyland, and I loved it as a kid too. So I play Candyland with them every once in a while. But my 6-year-old, if she doesn't get the card that she wants, like if she doesn't get like a double colored card, she gets like a single colored card, she just moves double. You know, the rules are always changing, and we get to a point where we just say, okay, Ainsley, her name's Ainsley. We just say, Ainsley, we're done. We're not playing anymore. Everybody gets so frustrated. And to me, that's kind of like where things are today, where no matter if the policy is going to be good or bad, there needs to be policy, there needs to be rules. Whether they're good or bad, there needs to be rules to play by. And if you can't have constant, consistent rules to play by, then there's no game to play. And I sit on a couple boards, and both the companies, they import from China. And both of them have said the same thing. They said, well, first off, they don't know the shipments that have been on the water for the last month that have just come in. A lot of ships are stuck right now because nobody knows if they're supposed to be tariffed at, the 140%, or if they're supposed to be tariffed at what it was before, or what. So they're just sitting right now. But what else it's done is it's made them put off ordering anything else for the future, and just trying to work through their current inventories because they just don't know. Because at 140%, one's a shoe company, a golf shoe company that's just golf shoes in general are a more expensive type of shoe. So your margins aren't near the same as it is in other areas. If you throw on a 140% tariff, all of a sudden the margins are almost next to none. So it might put that company out of business, or at least make it very, very tough. And we're seeing that across the board. When you look at shipments, you can already see in the data, shipments from week over week are down about 50% from China into the United States. And it's just because people are holding off their decisions to ship stuff. Now, it's not going to impact us over the next month or two because we have inventories, but over the next 6 months, we'll definitely start to see, it could be like another COVID where there's a lot of supply chain issues and shortages because people aren't able to. But really where it impacts the most is small businesses, because they're the ones that really have to make bigger decisions out further out, because they don't get the special favors for having massive shipments like a lot of these big companies do. So that to me, I think is the biggest issue we face today. It's not whether it's good rules or bad rules. We just don't have a rule book to play by. And that to me is what's most important. Yes.
I had a question about polar bear markets. Where are we?
Well, Ralph's gonna come up and talk about markets in perspective, so that's probably a good transition. But I would say that to us, this is a new bear market that started, and I think really when we get through this, I think it might end with either very slow growth or a shallow recession. Once we through this, the new bull's gonna start, and that's where I see the massive rebound that we see. So whether this is a true bear market or not, I mean, by just the market's take on it, 20%, if you're 20% off or more, you're in a bear market. That's not always the case, but it's a good reference point, and we're pretty much there. So I think we're in a bear market, and this is going to be choppy moving forward here. So again, you want to be cautious in this environment, but I wouldn't be out of it because I think there's a lot to go for this market once we come out of this situation. So with that, I'll really switch it over to Ralph. Is that a good point for you? Okay. Thank you all. Pleasure to meet you.
Thank you, Strider. Thank you, Kristina, for having us. My name is Ralph Oblakowski. I am one of the partners that works with Strider. Thank you all for being here. Thank you for the great questions. Thank you, Kristina, for having us. Strider really hit a lot of the things that Kristina asked me to speak about already, but I'll make a reference from it. So in addition to everything that we provide from an economic standpoint, we also provide a lot of references and resources that Kristina may have shared with you. So some of the slides that I'll share, you may or may not have seen before. And again, as Strider alluded to, yeah, we're in a little bit of a choppy time. We're technically in a bear market, which we'll actually see, but having somebody to kind of guide you through the best of times and the worst of times, I think is more valuable now than it has been in 30, 40, 50 years. Kristina's very lucky. She's now faced with inflation, which we haven't had in 40 years. So she's got all these tools in her bag that she's capable of pulling out and utilizing that will fit your financial needs. So I can't state it enough. Having a professional, and I work with 1,600 different advisors throughout this area. You got one of the best here with you. So congratulations to all of you being here. Congratulations, Kristina. But as Strider alluded to, right? So, this chart shows all the negative black swan events that we've gone through, going back all the way to 1970, right? You got wars, you have countries invading other countries, you have swine flu, you have Greece going bankrupt almost. You have COVID on here, and yet in the background, that's the S&P 500, right? The world is only going to end once. It didn't end any time on this chart. So I know, very profound, right? So no matter if we're facing a negative event, some sort of black swan event, chances are we're going to be okay. As Strider alluded to, we feel like it is a time to be a little bit cautious, a little bit safe, maybe not go for the home runs like we did for the last 2 years, where we saw a raging bull market tear through 20+% return in the S&P 500. That doesn't happen every single year. So we are a little bit cautious, but we don't feel like it's complete time to go to all cash and run for the hills. There is specific areas, and as history's shown us, there are specific areas of the market that still look pretty attractive, okay? This is another piece. So we all have gone through painful times throughout years where the market was negative. We may not pay attention to it as much because there's other things going on. It seems like there's a lot of eyeballs on the stock market right now based on what's going on with the current administration, tariffs, etc. This chart shows all the orange bars are the negative intraday or in that year from high to lows returns in the S&P 500. As an example, and the blue bars are what the actual calendar return was for the S&P 500 for that specific year. As an example, in 2012, At some point, we experienced a negative 10% decline for the S&P 500. However, we finished the full year at 13% positive. So while there's market fluctuates, right? That's why it's a market. So there's going to be bad times, there's going to be tough times, there's going to be painful experiences within the market, but there's a lot more blue bars. There's not a lot of blue bars that are actually finishing the full year at a negative pace, negative click, going all the way back to 1980, okay? Second piece is to answer your question, right? We've experienced bear markets. This is an interesting stat. The average bear market period lasts 11.1 months. This is going all the way back to 1942. 11.1 months is the technical definition we've on average resided in a bear market. And the average cumulative loss in a bear market is negative 31%. Ouch. Right, that hurts. That's the average. How many bear markets have we been in? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 bear markets going 1942. That's not that much, huh? No, but 11.1 months we spent in a bear market. On the flip side, the average bull market lasts 4.3 years. We don't high five it enough when we're experiencing a bull market. We don't celebrate it enough that we're experiencing a bull market. And guess what? The average cumulative return, 149.5%. That's pretty good. I'll take that. And then the second thing, second to last thing that I'll address is timing the market, right? You see a lot of negative headlines. I don't care if you're watching Fox News, CNBC, MSNBC, you're on your iPhone and you see negative headlines. And those negative headlines might make you feel a specific way, whether it's about a company or a sector. Your gut reaction might be, I'm out of here. I'm going to time the market. I'm going to sell out. Well, guess what? If you miss 5 of the best and all of a sudden, you know, it's a negative day and all of a sudden you say, hey, I'm good because I got out of the market. If you miss an average of 5 days, missing the 5 best days of the market, which might be the next day, a $10,000 return, a $10,000 investment you would miss out about $500,000 if you missed the 5 best days of the market, versus being a little bit disciplined, having a financial plan, sticking to that financial plan, and executing it, and having a professional that actually helps you guide through it. That's where you're going to be, right here on the very left side of the screen, okay? So there's no, we have a CIO, Dave McGarrell, he's got a great quote that says, there's a reason why the Market Timing Hall of Fame has 0 inductees. 0. We haven't had one yet. And then we've obviously seen a lot of swings, whether it's extreme volatile swings to the positive swings or negative swings. What's interesting here is after a negative, the worst days that we've ever seen, let's take Black Monday, 10/16/1987. In a single day, the S&P went down 20.47%. Ouch. 1 year later, you're up 23.19. 3 years later, another 11.6. 5 years later, 13.4. 10 years later, 15.43. So even though we have these wild swings that are occurring a little bit more violently and frequently, it seems like now, it's important not to have this gut reaction to those specific days. Again, I cannot emphasize it more. Having a financial plan, sticking to that plan, making adjustments to it. Life happens, I understand it, whether it's medical emergencies, you want to take a really nice cruise, things happen, but sticking to that financial plan and having somebody to guide you through that plan is extremely important. With that, I'll turn it back to Kristina.
Thank you very much, Roth and Strider. If you guys have any other questions that you haven't asked yet or come later on, feel free. You can also give them to me later on and I'll get you the answers. I'll get answers from any of our presenters today. I just know sometimes go home, you'll talk a bit and you go, oh, I didn't think about that question. So, what I really love about our speakers tonight is they do something that I'm lousy at, which is they actually have pretty charts. All of these charts and all of this information today that we share with you is available. This last one that Ralph just shared with you, I don't like to just send you guys stuff. You get enough in your inbox. I'm not sure what you care about, what you don't care about, what's valuable, not valuable, but all this is available to you anytime. So if you found this interesting, if this is something you want to use yourself to understand or to share with other people, because something that really keeps me awake at night right now is all the people out there that are scared to death because they have no one qualified to talk to. And not in addition to scared to death because they don't have anyone to talk to. They could be talking to or listening to on their phone, reading on their phone, information that's not correct. And potentially making devastating decisions to their financial plan and their financial future. There's a lot going on in the world right now. A lot of things is causing a lot of stress and a lot of concern. Dear clients, I cannot tell you how deeply it touches me that you are staying with the plan. Not a single one of you's panicked. Not a single one of you's run for the hills. Now, have you talked to me? Yeah. Had some conversations? Most definitely. Am I available to talk to you? If you have more questions, absolutely. You have entrusted us with your life savings, with your company's futures, with your nonprofit organization's ability to serve our communities. If you know how much time we spend watching very closely what's happening and making adjustments as appropriate and as necessary, this is our world, this is our life, and we are in service to you. So be sure if you've got people that you know that have concerns, that are worried, they want this information, you want to share it with them, you just let us know. We'll get it to you, get it to them. If they want to talk to us, Katie or I will make ourselves available after hours, clients first, always clients first. We'll make ourselves available to answer their questions too. Again, we're here to help our communities. I want to stress that because I see some of the stuff in the news as being shared as news right now, which news is a loose term. A lot of nonsense out there right now. A lot of falsehoods, a lot of opinions being shared as news. Okay, there's a lot of that going on right now. A lot of headlines that are factually incorrect or an opinion at best. And that's fine if you're watching news for entertainment. It's not good if you're losing sleep. It's not good if it's impacting your mental health. And it's definitely not good if it impacts your investing decision. Because as Strider mentioned, we don't know yet. We do not know yet what the results will be of the current administration's policies. There's a lot of opinions out there, but nobody truly knows because it's changing that quickly. There could be some very positive, beneficial outcomes, maybe not necessarily in the immediate term, but in the next couple of months here. And it could be something that's going to take a lot longer to work out. I'm telling you as an economist who pays very close attention to this, we don't know and no one knows how this will play out. What's important is to pay close attention and take action when necessary. Many of you heard me talk about this over the last couple of years. I do the monthly webinars, is that the markets are high. We expect volatility, we expect a correction, we expect a slowdown. You've been hearing me say this. I thought it was going to be last fall, but the massive amount of government spending pushed it out. This corrective phase was going to happen regardless of the results of the election. The trigger would have been different had it been a Harris presidency as opposed to a Trump, but it would have happened regardless because of the factors that were creating it were a long time in the running. New things are coming up, new policies, the change, the surprise are coming out day to day. Know that we're monitoring things closely and we'll make adjustments as necessary. There's never an overall adjustment, it's always individualized. Some of you in this room have money that you're investing for our distant future plans and needs. Others of you are living off this money as we speak. Some of you are living off the income. The fluctuation doesn't matter. Others need that principle. Finally, most of all, is that each and every one of you have something different going on in your life. Okay, it's not just about this. I know. I mean, you're all here listening to me tonight. That's really cool, but there's a lot more going on in life than this. And there's other priorities that will come up, and those other things that will drop to the wayside when you're focused on other areas of your life. And I'm bringing that up because each and every decision made in the portfolio is based on your individual plans. So if you ever want to know what's going on, what we're doing and why, ask please. We don't like to be a pest. We don't want to call you up and say, hey, here's what the market's doing today. Here's what we're doing about it. That's our job. Our job is to do that, to free you up, to live your best lives. Because that's why we're all here. We're not here to do this. We are, not all of you. So you get to enjoy that. And just know that the most important thing to know is that the environment's changing. Don't worry about the news. Let us watch it for you so you don't have to. My joke. It's actually a lot of truth to that. And ask questions when you have them. And that's we're paying very, very close attention to things that are happening. At this point, nothing seems to be significantly more onerous than bad policy choices and a market that was funded largely from government spending, government debt, and that is going away. The easy money is gone until it's recreated through natural economic growth, which is what it should have been a long time ago. So that's what we're watching for. Other thing I wanted to add to what was said here, this evening is there are different opportunities and different sectors that are still attractive. Some are good to hold on to because when this turns around, it could turn around very, very fast. The idea of timing this, and you guys all know how long I've been doing this, right? You're not going to time this one. When it turns around, it's going to be quick. And it may be all sectors. It may be the totality of the market. It could be just certain areas, but it's going to move quickly. So the idea of it is that being invested in the right companies and the right sectors for the right reason and tactically adjusting that is far more valuable than in and out. The other thing is, you guys have heard me talk about the boring old bond market for a while now. Most people weren't very excited about what I had to say about tax-free income and all the great things bonds do. But you know what? With the exception of a little hairiness last week, they got resolved pretty quickly. That's actually been doing exactly what it's supposed to be doing. And it helps ride through these times of more market volatility. So nothing I'm saying here should be construed as investment advice or recommendation. Okay, that's individual only. But there's a reason I talk about this stuff. And I try not to bore you, but I'm telling you for a reason. When we see these things, we always want to see where do we want to hold the money? Where's the opportunity? So that being said, I don't know what time it is here. I just want to make sure I'm not driving everybody all crazy. Is there anything specifically about the economy you all would like me to talk about? Because I literally have 3 questions that were sent to me in advance. So I don't have a lot, and I want to be respectful of everybody's time. And we're going to do a couple of things here. So is there any questions anyone has for me? Yes.
Social security.
Yes.
So, well, 2 things for me, but I'm reading firstly this. I know you're saying don't watch the news. Social security is going to be the solvent for the next 10 years. Should I not be assuming that social security is part of my retirement? My second question is for those of us that, I always understood that the best thing to do is to wait until 70. We don't need to have it today. Is that still true? Especially since we're hearing that it's becoming more and more difficult literally to get benefits.
I'll answer it in 3 parts, and I don't know where Katie is. There she is. By the way, before I answer your question, I just want to make sure for any of you who don't know her, this is Katie Lindfelt. This is our certified financial planner at Sequoia. She's also the future Sequoia. So when I'm no longer around in charge of things, Katie's going to be running the show. Now, don't get worried. I'm not going anywhere anytime soon. I'm only 56. So. But anyway, I just want to I think most of you know Katie, but I wanted you to also meet her. At Sequoia, we work as a team. The reason we work as a team is no one can know everything. Financial planning and economics is so complicated and changing so rapidly. One person knowing it all is almost impossible to do it and to do it well. So that being said, we work as a team at Sequoia. So in a few minutes, Katie's going to chat a little bit, but I'm going to throw a couple answers about Social Security. I'm going to see what Katie'd like to add because that's a planning question. First off, question for Social Security. So the possibility of Social Security becoming insolvent in approximately 10 years. The idea is should you wait until 70 because you get the biggest payout or do things sooner. And then I'm going to add the third component, and please add anything else there. Just they want to make sure they get that. I'm going to start with a question you didn't ask, but other people asked tonight, so I think I'm going to answer that if I can. So Social Security. So that being said, There's a lot of fear right now about Social Security going away or being taken away by the current administration or being cut or being reduced. I really want to address that one because that is one I feel very comfortable saying it's not happening. And here's why. Okay, the first thing I say, you guys are going to laugh at me and you're going to cringe, but I got to say it. Trump has said a number of times he's not going to do it. Now, I totally get that you may not trust what the guy's saying. Got that? Got that. Okay, but and I'll tell you the second reason. You cannot make changes to Social Security without 60% congressional approval. He doesn't have 60% congressional approval. And probably pretty much no one on Congress, including the Republicans, are going to agree to cuts to Social Security. So the way the system's designed, he cannot do it by executive order. He just simply doesn't have the power to be able to go in and take Social Security away. So I do want to address that because I got that question 3 times. And I really think that's important to say. So please don't allow that to be your concern. This comment, and I'm not saying your name out loud because I always protect confidentiality. This question, though, is important, and it actually is factually correct. Coming somewhere between 2027 to 2032 in that range, Social Security will run out of money based on current projections.
It's not like a pile of money that suddenly the money's gone, right? Like you save your investments are gone. It's that Social Security is funded by current workers paying into it, and that's going out. We reach a tipping point in which workers are not providing as much money as what is going out at that point in time, based on age and demographics. So yeah, there is a call, and about, depending on what year we look at, how we look at inflation, how we grow it, somewhere in 9 to 14 years.
And thank you, because gave the specific. And I want to add, there are solutions. So it's unlikely it truly will not be funded. Much of our country is dependent on it. The catastrophe of not having, because what would happen, or the rule of Social Security is there's automatic cuts of 12 to 20% across the board. Now, there's some people that can handle that, and there's a whole lot of people who can't. So there are solutions. The solutions are being talked about in Congress very quietly, because if you talk about doing anything to Social Security, you get in trouble. But the solutions are likely the Social Security payroll tax will go up to higher income brackets. There may be, for the young, the 20-year-olds, very young, they may have to wait a couple more years to collect, which makes sense. Understand, when the Social Security program went into place, most people died before they collected. Okay, now people are on it for 30 and even 40 years. Yeah, it's a demographic problem. It's not a program problem. So it just needs to be solved by being realistic of people are going to need to potentially work longer, but it's not going to hit any of you guys north of 50. Okay, your kids, your grandkids, they're going to have to plan accordingly, but it's unlikely it will. The reason is that no politician wants to be in that environment where this is not solved for, but also nobody wants to talk about it. So expect that the year it's going down is the year they're going to solve this. It's just kind of how our political, and it doesn't matter who's in the White House. It won't be Trump, it's too long out, but it literally doesn't matter who's in the White House. This is a sensitive subject, and it's going to be one that there are solutions, but it's going to be a tough one to solve for.
It's every single financial plan. So I research Social Security, everything we find out on it a lot, because it impacts every single working American, and non-working American, right? If your spouse paid in Social Security, you qualify for spousal benefits. I mean, it affects so many people. So mathematically, yes, it still makes sense if you don't need it for bigger planning reasons. Waiting till age 70, in most situations, is the best option. You're going to get the largest payout. The break evens for your personal life. It depends on how long you're going to live, but it probably makes the most sense. There's bigger picture questions there. If you have a spouse, it increases the possibility that waiting longer is better for the joint household incomes. But it really depends. But yes, I still think that waiting till 70 makes sense. I don't think of that as a risk, but I think would be the point of your question. Is it riskier to keep waiting?
So sorry, just to go back to the question about the insolvency. Should we therefore assume that we're going to get whatever we thought we were going to get?
So should we trust what's on the social security statements that we really will get it? If you are fairly close to receiving, so I used to say 50 was the number. I'm getting much closer to 50 than I was when I first started saying that. I don't trust mine anymore. I would say if you're north of 60, you probably can trust it, so long as you are going to work until the age you turn it on. That's what that number actually means. That number assumes that you keep earning at the same level until you turn it on. So if you retire early, that number is wrong. It's actually a slightly lower number, potentially, depending on your own work history and all of the math that goes into Social Security.
And I did want to add, if you have not done planning with us, okay, if you've done just primarily investment work or other thing like that, you ever want to do this type of deeper analysis in your personal and your family's personal situation, reach out, talk to Katie. Okay, because again, she can do this work for you and it'll be specific to your situation. Because another thing too is that if you're going to wait until you're 70, what is going to fund that period of time? Does that make sense? It's a whole combo looking at tax consideration, pulling money from IRAs. There's a lot that goes into it. So it's not a generalized advice. It's, we like it. Let us do it for you. So, okay, any other questions? Yes.
It's mentioned several times, possibility of taking social security earnings and payments and making them tax exempt. What do you think the probability of that is going to be given the current situation? It's pretty confident.
Well, that's actually a really good one, because the next issue, after we get through all this tariff thing, just in case you thought that that was enough, we're going to do, so Tax Cuts and Jobs Act, the current tax law expires the end of this year. So that is going to get renegotiated. Okay, so that does have to go through Congress. This is not a Trump thing or an executive order thing. I'm sure he'll be involved in it. One of the things that are important to him is, so just think of Trump having these three things economically that he's trying to do. Number one, he wants to close the deficit, that $2 trillion between the government's bringing and the government's going out, to get the debt down. He wants to do it himself, but he also really has to do it because he needs every single Republican on board with him. And there's a lot of really big fiscal hawks that want that dealt with. So that's an issue. But the other one is it's really important to him to do the stuff that he said he was going to do. He wants to check off the list, right? Here's all the stuff I promised you when you elected me, or you voted for me. So that being said, he wants to do no taxes on tips. He wants to do no taxes on seniors, Social Security. Those are things he's really pushing on. He's pushing on increasing the SALT cap, which will probably have the single biggest impact on many people here in California, because the high tax states, a lot of people never fully understood how bad California taxes are, how they're very aggressively progressive. So if you're in this really low level taxes, you don't really feel California taxes, but if you start poking your head up, the tax rates are really, really progressive. They go up really fast. So with that SALT cap going down to 10,000, that hit a lot of people pretty hard in these last few years. So the idea that also in the Trump's proposal is to increase the SALT cap. We don't know the exact number yet, but the proposal is around what, 50,000? So
Yeah, at least 20.
yeah. And so, but here's the thing that we need to understand: this has to go through Congress. Okay, this has to go through Congress, and that's anyone's bet right now how that goes through. There's a good chance it will, if that's the case. But remember one thing: remember the conversation here about the government debt. We're at $36 trillion. This is not sustainable. This is going to end very, very badly for our nation in the not too distant future if we cannot get government spending under control. So fine and dandy that we want to do the tax cuts, but we got to bring the revenue in. We got to close this gap. And that's the thing, is they actually have to show, to do these tax cuts, they have to actually show where the revenue's coming from. And this is, again, probably where a lot of that pressure is coming from the Trump administration, to be able to show where that money's coming from. Hence some of these policies you see. So I hope that answers your question. It is a proposal. I know it's going to be an important one, and it's likely that the new tax law will change, but we don't know what's in it yet. And it probably will not be known until later this year. Is that helpful? Sorry, I don't know the answer yet, but we're watching, because a lot of these proposals will impact everyone in this room. So we're going to keep close eye on it. Any other questions? Yep.
Is there any other better opportunities looking at other countries right now? In terms of investments?
Are there better opportunities in other countries looking at investments? Certainly, but there always is. So it's not necessarily unique to this situation, but there is always opportunities and there's always risks in investing in other countries. Other countries, we have to look at the country risk itself, the currency risk, fluctuation, the currencies are a big deal. So the answer to that is generally depends on the individual circumstances and situations. Also, a lot of companies now, especially large ones, they're not really in a country. They could be domiciled somewhere, but where's their revenue coming from? Okay, Apple is domiciled in the United States, but where does this revenue come from? Right, so we have a lot more blurring of the lines, especially in larger companies. And in other countries too, they only have their own internal risks that we have to look at. We were talking about, Katie was talking about Social Security. You know, one of the other big reasons Social Security is in trouble is we're not making enough babies. So gosh darn it. Well, I'm guilty of that. I don't have any kids. So there you go. We're not making enough babies. The whole program, the whole way our economy runs is all these new workers are coming in and they're paying into the system. And that's what's paying for all the older workers, right? But we're not. And we're expected in, what's it, 2032? What's the year we're expected to actually start to go negative? So we're not making enough. I mean, our replacement rate, right? We're starting to drop. Well, there we go. Okay. I got a positive thing. Here he's doing his part. But that being said, yeah, it's simply that issue that we have is we're not for our current economic system. So we're not as bad as Japan, China, and Europe. They're in serious trouble. And so and that's a lot of issues. Russia is another country. It's in serious issue. And you're going to start to see more distress in these countries because it's going to impact their economy. Oh. You want to add anything? Okay. So very individualized, depends what you're trying to do, depends on the risk level that you're willing to take, and it depends what else you're invested in, what else you're doing. Any other questions? Yes. Why do you pick the one?
Another entertaining get ordered by Trump about 3 weeks ago. He wrote something about making housing affordable.
Mm-hmm.
So basically, reducing unnecessary regulation on construction, which supposedly will bring private contractor 25% down. And another one I don't understand at all, making housing more affordable by removing all the government subsidies to first-time home buyers, etc.
I have heard of it and I have not yet reviewed it to see what the specifics are. Oh, sorry. The question was regarding a executive order that Donald Trump wrote recently that was supposed to make housing affordable by reducing the regulation to build houses, but also at the same time reducing a lot of the government subsidies for first-time home buyers and other incentives. I have not read it, so I don't know what the details of it are. And to be quite honest with you, a lot of these things that come out, we have to and I'm saying collectively, everyone has to figure out how does this actually apply to law? Like there's an executive order, but it's short on details. So what's the specifics? How does this work? Ultimately in housing, the biggest issue we have is the supply and demand imbalance is so great. And that has created in some markets a huge affordability issue. It's that imbalance, right? Where you have more people who can afford housing, but housing can't be built. This area right here is ground zero for it, right? So they try to build more housing here to make it more affordable and then people get upset because downtown Santa Cruz starts to look like downtown San Jose. There's just not a lot of places to build and there's a lot of different ideas of how that should be done. But you go outside, as many of you know, I also live in Nevada, Gardnerville, Nevada, and you can buy a beautiful home in a suburban neighborhood for $400,000, $500,000, 4-hour drive to the Bay Area. Right. So that's why you're seeing this movement of people out of California into other states. It's not because they hate California. Some of them do, I'm sure. But most of it is affordability. So affordability is relevant to the income and also the cost and the availability of housing. There's a lot of variables going there. So simply reducing the regulations can bring the cost down, but will it bring it down enough to make it affordable? I would argue that when we had sub 3% mortgage rates during the pandemic, that made housing a whole lot more affordable than anything that we're doing right now at 6% mortgage rates. Right? That when people are looking at affordability, they're not looking at the price of the house, they're looking at, can I make those monthly mortgage payments? And so just in that, if we can get inflation, the inflation data we got recently is positive. I mean, it's good, it's coming down. Is that going to continue with everything else going down? We don't know yet. But if we can bring interest rates down, if we can bring housing affordability down in loans, that will help even potentially more than that. But it can make a big difference if you can make housing more affordable to build. Because a lot of costs of building housing here, it costs $500,000 to build a simple home. In the Bay Area, they were building homes for to house the homeless population. All right, very simple, very simple homes, no bathrooms, no nothing. And they would cost a couple $100,000 each to build. Stunning what it costs to build. And this is again shared bathroom. This is just a little a private room. So yeah. I think there could be a lot done, but is Trump's executive order the solution? I haven't read. Any other questions?
Last question. You've indicated that you rely on data, which is comforting as opposed to emotions. And yet we're dealing with a president who's completely unpredictable. So I'm trying to gain an understanding of what data is being looked at under these conditions.
Data, because ultimately everything comes down to data. So there's forward-looking data. That's the highest probability based on everything that we know now, but it's forward-looking. And there's backwards-looking data, what happened last month or last quarter. When you have okay, we're going to use the example of an unpredictable president, certainly. Whether you like the guy or hate the guy, can we all agree that attacking the Federal Reserve Chairman is probably not? Okay, sorry. I had to say that. I'm not getting into politics, but you know, our Fed chairman's like a really important person. So we really, there are things that sometimes are like, okay, we can't model for that. We can't model for the market's reaction to events. We couldn't model the COVID, the pandemic and the lockdown, right? There was nothing historically for us to model. So data will not solve for everything. You're just going with highest probabilities, and you have to be willing to change if the data changes, which is critical. Why Katie and I, we don't hold a political view. We don't hold a social view. We don't hold anything that will make us, our viewpoints corrupt. Because the minute you hold a view, then you're always looking for data to support that view. We put all that aside and we're saying, what is the data showing? And if something changes, we're willing to change our mind that quickly. But we don't react to news because news is nonsense and it's mostly after the fact anyway. So it's probably right now we're in earnings season. I can't tell you how many good reports have been out there. Like amazing companies doing an amazing job and are guiding, they're like, tariffs, what tariffs? We're going to do great. And then you have a little surprises. Let me throw one out there real quick. United Healthcare. Okay, so last week, I mean, maybe you guys didn't notice, I always notice, there's an amazing event where the NASDAQ is flying and the S&P is flying up and the Dow is cratering. And you know why? Remember, the Dow's 30 companies, okay? So generally it moves a bit more based on those companies doing, but United Healthcare came out with a horrific report, horrific. And I know that not everybody's friends, so I get that no one here is crying over it, but I want to tell you why the report was horrific and why they took down the Dow. It was nothing to do with Trump, nothing to do with tariffs. It was everything to do with one thing that they missed, which is during the pandemic, the Biden administration did this enhanced Medicare funding. Okay, I'm probably calling it the wrong thing, but it's enhanced Medicare. Basically, they put more money into Medicare because they want to be sure that our most vulnerable citizens had ample access to health care during that time. Okay, so they enhanced Medicare specifically around the pandemic. Before Biden left office, he cut that program. Now, it was supposed to be, I'm not blaming Biden. He was supposed to have it. It was supposed to be cut. He cut that program. All that extra money was sucked out. Most of that money was going to the Medicare Advantage plans to help make them more affordable for seniors to be on those plans. United Healthcare missed that, and they got their heads handed to them. So why I'm bringing that up? If you focused on Trump and the tariffs and the news, you would miss that a mile away instead of seeing, hey, this program's been cut, who could be impacted by it? So a lot of the stuff that happens is not what you're going to get going on X or going on CNN or Fox or whatever you choose to listen to. A lot of that information is quietly happening behind the scenes. And so I want to bring that up. I hope that helps, right? There's unpredictability and then there's a lot of predictability as well. And you know, when there's no unpredictability, that means you're missing something. In case anyone else's life here is predictable. All right. Any other questions? Not everybody? All right, Kay, I don't know if you want to say anything before I close out.
So yeah, financial planning is my side of the ledger here with Kristina. The one bit of fun right now I'm telling everybody is there's one really great buy out there. If you've ever considered a Roth conversion, they went on sale. So if your IRA has dropped and we were thinking of doing some Roth conversions, I could convert a larger percentage of it for the same tax dollars. It's something to look at. I like Roth conversions. They're something I talk with folks all the time. It's a small consideration out there. If you've ever wondered about it, now's a good time to look at it. Tiny little takeaway. I called it, a bit of a silver lining when the markets get rocky within things. So a Roth conversion is when you take some of your IRA, that money you've not yet paid taxes on, you move it over to the Roth, which is a bucket where the taxes have already been paid. It can grow then. When it comes out, no more taxes due. Doesn't make sense in all situations. It's something I play with every day in financial planning with folks, looking at it there. So that's my little tiny takeaway, something to think about. May not make sense for you, may make sense for someone. Oh, and Kristina's going to show some fun there.
Literally, there's too many computers there. I was afraid to touch the wrong one and just check.
Kristina's not our tech expert.
No, do not. Okay, for blue, yeah. Time starting, yeah. No, tech, too. Very. So, you put up. Oh, you put up a couple more, so okay.
Yeah.
I said, my name is Fort. So, as we wrap up here this evening, thank you, Katie. As we wrap up here this evening, I get a lot of questions from people that oftentimes ask, what do you do when you're not doing this? Like, we know you love it. We know this is your world. And so I'm going to quickly share a story. Maybe defines a little bit about the hero's journey and showing that you're never too old to be challenged, to be put in an uncomfortable situation, to get through it and learn something new about yourself. So many of you may know, I have 2 wild Mustangs that my husband and I adopted. Got them completely wild off the range. We live in Nevada. There's wild Mustangs everywhere. They're kind of like raccoons. Yeah, here I'm here. So that's me on Duddy. Actually, that's funny. That picture just was on Good Friday. The other picture was older. So when I was out in Nevada working with them. So when I did it, I'd been around horses a little bit when I was young. Never owned them because we were far too poor for that, but took care of some of my neighbors' horses. Really loved them. And I got older. This was kind of like a vision I'd always have of, okay, I want to train a horse and I want to rescue a horse, right? I don't want to just get some fancy horse. I want to rescue a horse that has, give it a better life and train it. And I was so sure with the assistance of my trainer, I would be able to do this in my abundant time off. I worked 12-hour days. And so we went forward. We adopted these 2 wild Mustangs and we worked, when we were in California, our trainer worked with them, we worked with them. And it was going along. But I want to tell you, I had no idea what I was getting into. Like, no idea. I have been kicked. I have been bitten. I have been thrown off. Sometimes all 3 in the same day. I've been pretty seriously hurt more than once. If you notice, I do wear a helmet. So, hey guys, I'm protecting this for you. Protecting this for you. It's important, believe it or not. It hurts when you fly off a horse. So it was going fairly well. The horse progressing, riding the horse, and everything's going well. But I got really busy and I couldn't spend a lot of time. So there was leaving the horse with the trainer all the time to work and boarding the horse, and just because I want to make sure that we didn't lose in the training. And one day I went back to work with him. He's getting older. Dunny's a gelding. Dunny decided he was the leader of the herd, not me. Now you have to understand, a horse is a powerful animal. It can kill you in a heartbeat, right? So you have to be careful. When the horse decides he wants to be boss, you got to get them back in line pretty quickly. Well, I got kicked pretty hard, and then something happened to me that hasn't happened to me in God knows how many years. I got scared. I truly became afraid of my horse. So what happens every day I go out there, I'm a little bit nervous. I'm a little bit nervous getting to pen with him because I know what's going to happen next. Horses can smell fear a mile away. So here we go. He's like, huh, you're afraid. I'm the boss. I'm going to be even tougher. Excuse me. So I had to get past my fear of injury because I've been hurt a lot of times. And, again, a couple times pretty seriously. And I also realized that if I didn't show this horse who was boss, I was going to lose him. I would lose him. I would lose his respect. I would lose him as my horse. And I wouldn't be able to keep him, which means a bad outcome for him. So what I had to do is he pushed all my buttons. Patience. If you ever trained an animal or maybe even raised children, patience, consistency. I had to be mean. Okay. Now you don't have to abuse an animal, but when you're training a big animal like that, the only thing to understand is you have to be tough. I had to get in his face. I had to hit him. When I say hit, by the way, I want to make sure it's a little piece of rope on the end of a whip. It does not harm the horse in any way. I'll stress out, but it scares him, right? I had to be fierce. I had to be consistent. I had to be patient. And if it took me 2 hours to get to walk 3 feet, that's what had to happen. But I had to do it because it didn't matter how much time and energy my trainer would put into this horse. If the horse didn't learn to respect me, I would lose the relationship. Well, I want to share with you that it's been 3 months since I got thrown off. And it's moving along. And the reason I started to share this story with all of you is that I had a path, I had a choice what direction I go. One is to say, I can walk away. I don't need a horse. That's not what I do for a living. I walk away, give the horse to the trainer. If she'd love a free horse, it'd be great. Everybody's happy. Okay. The other one is I could continue with the commitment I made to that animal the day that I rescued him. And in that path, I could also learn about self. Because learning to be present, aware, consistent, and patient were all lessons for me to learn in life. They were all things for me to do. And from this experience, the bond between myself and Dunny is greater than ever. The accomplishment is greater than ever. That picture right there was a ride I just did on Good Friday before I headed back to California. We went on a long ride. He didn't buck me off. He didn't do anything. It was the most peaceful, pleasant ride together because we're connected. And it only happened because of that. So why am I telling you my horse story? Number one, to know that I do things besides finance. Number two is to show this level of commitment. If I take on some responsibility, my commitment is from the heart as much as it is from the mind. I make commitment to each and every one of you and the work that we do tirelessly to ensure your success with everything that's within our power. If you knew the amount of time, effort, and hours that Katie and I spend on your financial plan and on your portfolios, you'd probably think we're a bit crazy. We really, 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 it's our highest priority that you're successful. And that's what it takes, that commitment and that discipline and that focus. The final thing where it connects to it is we're never too old to learn about ourselves, our relationship with others, and our relationship in our life. It's fascinating. It's you're never too old. If you're still here, you're still alive, you're still breathing, there's something to learn and there's something to experience. As many of you know, I go to Peru twice a year. I do some pretty deep spiritual, personal work, as well as volunteering, helping the local communities down in the jungles of the Amazon. Again, lessons learned. Boy, we have way too much stuff in this country. It is stunning. If you've ever been to some of the other parts of the world, see how people live. And okay, it's the water levels are high right now. Every animal they own is on the one level of the house everyone's living in, right? The basic necessities is it, right? We go on a canoe and we're on the treetops, right? Because the water's really high. We go on a canoe, we hack down a termite nest and we carry it back to feed the chickens, right? And it's really cool. How much I spend on chicken food for all my chickens? It's like crazy. I want to go to Peru and just hack down a termite nest and then beat it with a machete and all the termites fall out and the chickens are fed. It's stunning. It's just that, but it puts perspective into life of how much we can learn and how much we can experience and how much we can do. So again, bit of a story, kind of end the evening on that is that regardless of what is happening in the world, find your joy, find your purpose, find your why. Because it doesn't matter what's in the portfolio if you're not living life to the best and highest purpose for your rich, meaningful, and purposeful life. Thank you all very much for coming tonight. It is a very special treat to see each of you in person. And for all of you on the Zoom, also watching, we had a lot of signups for the Zoom. So this is a little special event. Please do add your comments if you have any on your cards. And please also, I know this sounds corny, but regulations require that we have everyone sign in who attends an event. We promise you this leaves nowhere. It is just for audit purposes only. We're not selling your name or information to anybody. This is obviously, as you know, confidential, but we are required to do this. So that's just, we have to say that, do what you want to do, but we've said it, so we're good. Thank you all very much for coming tonight. Thank you.